you screwed? 5 signs your financial plan is failing. Warren Buffett and Ray Dalio, 2 of the most respected investors in the world, have been raising concerns about the state of the global economy, and it could spell trouble for your financial plan. Let's break down 5 critical signs that your plan might be failing, and explore practical steps you can take to fix it. We'll illustrate these points with real-life scenarios to help you identify whether you're on shaky ground. 1. Over-reliance on debt. The leverage trap. Warren Buffett has long been wary of using excessive debt to fuel investments. He believes that leveraging too much in times of uncertainty is a recipe for disaster. Imagine you've invested in real estate and borrowed heavily to expand your portfolio. On the surface, this might seem like a sound strategy, especially in a booming market. But what if interest rates rise suddenly, making your mortgage payments skyrocket, or if the property market cools down and your assets lose value? You're left over-leveraged, unable to service your debt, and facing potential bankruptcy. Buffett warns against relying too heavily on debt, especially when market conditions are unpredictable. Real-life example: in 2008, the global financial crisis exposed the dangers of over-reliance on credit. Many individuals and companies who borrowed heavily during the housing boom were wiped out when the bubble burst. Solution: reevaluate your debt levels. If you're highly leveraged, work on reducing your reliance on credit. Focus on building a solid cash reserve and avoid taking on additional debt in volatile markets. 2. Lack of diversification. The all eggs in one basket problem. Buffett's second concern is the importance of diversification. Imagine you've invested all your money in tech stocks, believing they'll continue their meteoric rise. Suddenly, the market shifts, and the tech sector crashes, wiping out a significant portion of your wealth. Buffett emphasizes that putting all your bets on a single asset class or industry is risky. Diversification, or spreading your investments across different sectors, can protect you from the downfall of any one area. Real-life example: many investors who overinvested in companies like Enron or Lehman Brothers lost everything when these giants collapsed. Those who had diversified portfolios, however, were able to mitigate their losses. Solution: diversify your investments across industries, asset classes, and even geographic regions. This way, if one sector suffers, your overall portfolio remains more secure. 3. Lack of liquidity. Can you handle a crisis? Another critical mistake is not having enough liquidity, cash or assets that can be easily converted to cash in times of need. Say you've invested heavily in long-term assets like real estate or illiquid stocks, thinking these will provide substantial returns over time. But what happens if you suddenly lose your job, or there's an unexpected medical emergency? Without adequate cash reserves, you may be forced to sell off investments at a loss to cover your expenses. Real-life example: in the COVID-19 pandemic, many businesses and individuals who didn't have enough liquid assets faced financial collapse. People had to sell off stocks at depressed prices or couldn't access funds fast enough to cover urgent expenses. Solution: ensure you have an emergency fund that covers at least 6 months of living expenses. This cash reserve will give you a financial cushion during unexpected events, without forcing you to sell investments at the wrong time. 4. Chasing quick returns. The get-rich-quick illusion. We've all seen the lure of quick money, whether it's investing in the latest hot tech stock or getting involved in high-risk ventures like cryptocurrency during its hype phases. Buffett cautions against this kind of speculative behavior. Let's say you invest in a penny stock or cryptocurrency based on a friend's hot tip, without doing any due diligence. Initially, the value skyrockets, but within months, it crashes back down, leaving you with massive losses. Real-life example: many people who invested in Bitcoin at its 2017 peak lost money when its value plummeted. Those who chased quick returns without understanding the market ended up paying the price. Solution: adopt a long-term view. Avoid chasing quick gains and instead focus on sustainable, steady investments. Warren Buffett's approach of investing in solid, reliable companies with a long-term growth potential has proven to be successful time and time again. 5. Ignoring global risks, geopolitical and economic blind spots. Ray Dalio warns of a new, more volatile world, with rising geopolitical tensions, economic inequality, and financial instability. If your financial plan focuses only on local or short-term issues and ignores global risks, you might be in for a rude awakening. Imagine you've invested heavily in a country with a stable economy, but then a geopolitical crisis arises, trade wars, sanctions, or even military conflict, leading to an economic downturn that hits your portfolio hard. Real-life example: investors in Russian or Ukrainian assets faced massive losses after geopolitical tensions escalated into military conflict in 2022. Those who ignored global risks and concentrated investments in these regions saw devastating effects on their portfolios. Solution: diversify internationally and keep an eye on global trends. Investing in international assets or global ETFs can shield you from local crises and ensure that you're not overexposed to the risks of any single market or country. Practical steps to protect your financial plan. Now that you've seen the warning signs, it's time to act. Here's how you can protect your financial future. Review your asset allocations. Move some of your investments into more conservative, stable assets such as government bonds or dividend-paying stocks. Build a robust emergency fund. Make sure you have at least 6 months' worth of expenses in liquid cash or easy-to-access assets. Diversify globally. Don't put all your investments in one country or region. Spread your money across different markets to reduce geopolitical risk. Pay down debt. Focus on reducing any high-interest debt you may have. This is crucial during periods of rising interest rates. Avoid speculation. Don't chase after the next big thing. Stick to solid, proven investment strategies like those advocated by Warren Buffett and Ray Dalio. Conclusion: preparing for an uncertain future. Both Warren Buffett and Ray Dalio have successfully navigated decades of market turbulence by sticking to core principles: diversification, conservative risk management, and an eye on global risks. The economy might be unpredictable, but by following these time-tested strategies, you can protect your financial future, avoid unnecessary risk, and be prepared for whatever comes next. Make sure your financial plan is built to withstand uncertainty, because the storms of the global economy are inevitable.